Okay, so let's get started. We're going to go over today in our session trading futures, and specifically trading the E-mini S&P 500. And this is more of a beginners type session, just to familiarize you with futures, what they are, and so on. And in another session, we'll actually go a little deeper and we'll get into how to trade them, as far as patterns that we're looking for, that type of thing. We'll go in a little deeper. We just don't have time to do both in one session. It would just make the session too long. And this was another session that was requested by you guys, by the group, as something that you wanted to focus on to go over. So here we are today. So basically, what is trading futures? What is a future, right? Some people are not sure about that. So basically, what it is it's a contract to buy or sell a particular future or commodity on a specific date at a specific price. And if you're a history buff, this thing kind of spun off a long time ago, when, let's say, you had a particular farmer and he farmed corn, and he didn't, he wanted that security of knowing what price he could get on his corn at a future time when his corn crop was ready, let's say. He didn't want to speculate because he has a family to feed and everything else, just like all of us. He wanted to make sure that he could get a certain price. So he would get with a buyer. They would do a contract that said, hey, if you're willing to buy my corn on December the 12th or whatever that date is, okay, that would be your future contract options or future contract expiration date, right? Then if you're willing to do that at whatever it is, $1.50 per pound or $2 a pound, then let's sign a contract. That way we're both safe. I know that I'm going to get X amount of money from my corn in case the price of corn were to go down. And the buyer, he will be able to buy that corn at that date for X amount of price in case the price of corn went up, right? So it was kind of mutually beneficial. And that's kind of where it all started. And it's a little bit different now, but that gives you a general idea of what they are. And the price on futures, if you look here on, let me spread this out a little bit here. If you look here on the ladder, you'll see the increment. So they don't trade, they don't move like a normal stock that we're probably used to, right? They move, in penny increments. Well, and these different futures will move in different increments, but we're going to specifically talk about the E-mini S&P 500 today because it's the most popular, right? It's what, if people are trading futures, most of them are trading this particular future. Nasdaq is popular as well. CL, which is sweet crude oil, is popular. There are other ones as well, but this one I would say is the most popular, which is why we're going to just kind of use it as our example today. But it moves in quarter increments, as you can see here, 25 cent increments, right? So that'll be, that's a little different. Doesn't move in pennies. It moves in 25 cent increments. And it also, these increments, these 25 cent increments are called ticks, right? So when you move from 45, 20, 29, 25 to 45, 29, 50, that's one tick, right? 2 ticks there, 3 ticks, and so on and so on. And then once you get to a full point, would be from 45, 29, 25 to 45, 30, 25, right? That's a full point. And we'll go over what the differences are. So what you need to trade these futures. So depending on which future you're trading, and I'll show you some examples here. We'll go to our futures trader here. It will tell you what your margin requirement is. So this is the ES for TD Ameritrade anyway, is the S&P E-mini, S&P 500 E-mini, right? So your required margin per contract is $15,812.50, okay? This is the micro E-mini for S&P. and it's $1,581 per contract. So, and you've got your NASDAQ here, 23,375. You've got crude oil here at 84.15. You've got mini Dow Jones here at 12,375, and you've got Bitcoin futures at 176,368.50. So that will let you know what the margin requirement is per contract. So if you have an account that is, $10,000 size, well, on TD Ameritrade anyway, you wouldn't be able to trade even one E-mini contract. You could trade a micro E-mini contract. So make sure and take a look at those, and that basically will hold up that amount of margin or of your buying power per contract that you trade until you close the trade. So that's where you can find those. So we're looking at pretty close to 16 grand on the S&P 500 E-mini. Okay, so 15.8 there. So 5 contracts. That's going to cost you roughly 80 grand, right? That's going to tie up 80 grand. Most day traders, obviously, they're not that concerned about that because they're only day trading it. They're not holding it overnight or looking for a swing trade on it for 2 or 3 days, so it's not that big of a deal. Some people are just scalping it. They'll scalp it for a point or 2 points. So it's to them it's not that big of a deal. It does obviously have a larger impact if you're holding it for a longer period of time because it's going to tie up that capital. And of course, once you sell or close your position, then that capital is obviously freed back up. So what we're looking at on the S&P is we're looking at for each tick, which is 25 cents, right? Per contract, you make $12.50. Okay, so for each point, which is 4 ticks, because to make a point, you need 4 of those 25-cent increments. It's $50, right? So every point you make is $50. It doesn't sound like a lot of money, right? Especially for the amount of capital that you have to put up in order to make the trade. But it can really add up depending on how long you hold it, depending on how you trade it. And like I said, we'll probably go over that more in our follow-up session. So the fees, there's also fees. Every broker is going to be different as far as what they charge for fees. I can tell you that TD Ameritrade charges $3.50 for each contract each way. So each way meaning buy. So it's cost you $3.50 to buy, and it costs you another $3.50 to sell it. So just look at it as a $7 turnaround per contract. So if you're buying 5 contracts, it's $35, right? So you have to make sure that if you're buying those 5 contracts, that you certainly want basically $35 is your break even. So $35 profit is your break even. And if you end up having the trade go against you, then you're just going to have to add the fees onto your loss, right? So that's definitely something to keep in mind. And that's why you see a lot of people won't scalp for 1 or 2 ticks because it doesn't make sense because of the fees, right? If you scalp for 1 tick on 1 contract, you're only making $5 basically. And if you have 2 contracts and you scalp for 1, well, it's about the same anyway. So you have to keep that in mind. Keep the fees in mind as well when you are trading futures or anything where you have broker fees associated with that trade. So let's say that you did take a trade, and let's say that you did 4 contracts. That's roughly $64,000 in margin needed, right? And the price moved 5 points from 45.25, we'll say, to 45.30. Well, you made $1,000, right? Less your $28 broker fee, so your net would be $972. And it's much easier than it sounds for it to move that much. This is a very, very liquid, this particular, the E-mini S&P 500 is very liquid. So it's very easy to trade, particularly during market hours. So you can trade these pretty much around the clock, 24 hours a day, 6 days a week. There are small downtimes for maintenance. I'll give you some of these times now if you're interested in that. So trading hours, I'm going to say these are in Eastern time, so market time. They open for trading on Sunday at 6 p.m., right? So you could trade starting at 6 p.m. on Sunday, and then they don't close until Friday at 5 p.m. So you can pretty much trade them 24 hours a day. They are down for maintenance Monday through Friday for 15 minutes every day during the week. They're down for 15-minute maintenance from 4:15 to 4:30. Okay, not that big of a deal, 15 minutes. And then Monday through Thursday, they're down for an hour from 5 p.m. to 6 p.m. Other than that, you can trade them, you can get up at midnight or 2 o'clock in the morning and trade futures. That's one thing that people like about them. I can tell you, I've traded futures, this particular future, quite a bit. And I can tell you that during those weird times, if you want to get up at 1 o'clock in the morning and you can't sleep, and you're like, well, I can't sleep anyway, let me see if I can trade some E-mini S&P 500 futures, right? Well, I can tell you that they're not as liquid. They do move quite a bit slower during those oddball times for obvious reasons, right? But they are still tradable, but it just takes a little bit more patience. So as far as your broker goes, some brokers will require a special account, special account tier, approval level, basically, to be able to trade futures. I don't know. I'm sure it's different with every broker, so check with your broker on that. I know with TD Ameritrade, that is the case. You do have to have a special tier. I think it's level 2 or something, or maybe level 3. I don't know. It's one of the two, but you can just check with your broker to see what that is, because with most brokers, you do have to be approved in order to do that. But with TD Ameritrade, it's very easy. You just go on to the main TD Ameritrade website, you log in, you go to that particular area with futures, and you hit a couple of buttons that says, hey, I want to be approved to trade futures, and then usually within a day or two, you can look back on your account and it'll either be approved or not approved. And what they base that off of, I have no idea, but that's how you do it anyway. So check with your broker on that. We talked about it being very liquid. We talked about the fact that it's much more liquid during normal market hours, and of course during pre-market when economic data is coming out in pre-market. It's certainly liquid at that point as well. So when you're looking at trading futures, what time frame, what chart time frame should you be looking at? Well, that really depends. Just like with day trading regular stocks like we do, it really depends on your trading style. Some people day trade on the 1 minute chart. Some people day trade on the 5-minute chart, on the 15-minute chart. We have a guy in our group, he's real big on the 2-minute chart. So it really, kind of comes down to your style, right? And your personality, what works best for you, basically. It also is going to depend on how you're trading that particular future. Are you doing it for a swing trade, or are you day trading it, right? If you're day trading it, then yeah, you want to be looking at a lower time frame chart. If you're swing trading it, then yeah, you probably need to be looking at the weekly chart and the daily chart and the higher time frame charts, right? Just like we would on a normal stock. We're not taking a swing trade on a normal stock off of the 5-minute chart, right? We need to identify what's going on a longer time frame chart. So, keep that in mind. Depends on what your personality and what you're doing, what type of trade you're looking to do on that future at the time. So if you are day trading, like I said, some of the popular for futures, some of the popular time frame charts are a 2-minute, a 5-minute, or maybe even a 15-minute. And a lot of people will also use tick charts. So maybe some of you may not be familiar with what a tick chart is. So we'll go over that for a few minutes here. So a tick chart basically it starts a new candle. So let's back up for a second. So if you're on a 1-minute chart, every 1 minute, no matter what happens during that 1 minute, every 60 seconds, you're going to start a new candle, right? Same thing on a 5-minute chart. Every 5 minutes, no matter what happens, you're going to start a new candle after 5 minutes has expired. A tick chart will form a new candle after a certain amount of contracts have been traded, and it depends on what you set that tick chart to, right? So when I trade E-mini S&P 500 futures, I like to use a 2,000 tick chart. So what does that mean? So a 2,000 tick chart means that you're going to form a new candle after 2,000 contracts have been traded, okay? And we'll, versus just over a set amount of time, like a 5-minute chart. And we'll go over what the difference is as far as why you might look at a tick chart either instead of or in addition to a certain time frame chart. So think of it like this. So if we're looking at a tick chart, you're basically looking at the action, okay, of the future in this case. You're looking at the action based on a specific amount of data, okay? And the example that we used was 2,000 contracts. So you're looking at, in the last 2,000 contracts traded, how did this act, right? Versus looking at the action solely based on time, okay? Your tick chart amount, again, will depend on your trading style, okay? Some like to use a tick chart number that's a Fibonacci derivative. You know, they want to look at a 236 tick chart or a 382 tick chart or a 618 tick chart, right? Or they'll stick with an amount that they found that corresponds with their trading style. Give me 1 second here, guys. Need to turn something up here. Sorry about the pause here. Okay, that should be better. I forgot to turn my volume up, so I'm hoping that the recording won't be too low volume for everybody. So, you know, some people will look at, you know, just a certain tick chart that they, like I said, that they have found that corresponds with their trading style. And, you know, that may be whatever it is, a 500 tick chart or a 1,000 or a 1,500, 2,000, whatever, right? Basically, you just need to find what works for you, your personality, and your trading style. And you can always look at more than one chart, of course, right? I know with me, at any given time, I have 5 charts up on 2 different screens. I have one screen with what you're looking at right here is my main trading screen. And then on my on a secondary monitor, I have 4 charts up. And depending on what I'm trading will depend on what type of charts those are, right? So if I'm trading regular stocks, I've got a daily up there, I've got a 5-minute, and then I'll switch back and forth between, you know, a 2-minute, 1 minute, or maybe have some different types of indicators on those other 2 1-minute charts. Just depends on what I'm trading. For futures, I will switch that up. So I'm primarily on my main screen, I'll be looking at a 2,000 tick chart, right? That's what I feel like works best for me. That's what I learned off of. And so that's what I stick with. But at the same time, I'm also looking at a 2-minute chart and a 5-minute chart. And sometimes I might even throw a macro tick chart up there just to identify those areas, right? Maybe that might be a 10 tick chart or a 50 or a 100. It just depends. So you really have to find kind of what works for you. And the best way to find that is to paper trade. You know, this is one of those that you want to be careful when you first start out trading, because it doesn't trade like what we're used to trading on a daily basis. It doesn't trade like that. It's very different. And this is one of those you would definitely want to watch for a while to see how it trades, see how it reacts to certain economic data. This is not something you want to just jump into on day one after a 1-hour session and just go for it. Definitely not. You certainly want to spend some time in learning it, watching what it does, paper trade it until you feel comfortable and you're confident that you can be consistently profitable. And it's also going to take you that time to figure out how you're going to trade it, what charts you want to use. It's going to take some trial and error, back testing. You always want to back test everything before you start throwing real money at it, of course, right? Okay, so with tick charts, they also, they allow you to basically see the actual movement, right? So if you're looking at a 5-minute chart, yeah, you to see the movement, yeah, you can see the candle going up quickly, yeah, and you can watch the volume, sure. But with tick charts, when your candles are filling up, if you've been watching, let's say the E-mini S&P 500, if you've been watching that for the past 30 minutes, you're looking to maybe take a trade on it, you're waiting for a particular setup, you pretty much had kind of gauged how quickly those, let's say you're on a 2000 tick chart, how quickly those candles are filling, right? Well, you'll notice immediately when you have a lot more action coming in or less action, because those candles are going to be forming much quicker, right? Maybe your last candle took 5 minutes to form, but this candle, it formed in 1 minute. You're like, whoa, wow, there's a lot of action coming in here now. Lots of contracts are being traded quickly. That's another benefit of using a tick chart. Okay, so let's talk about a few benefits of trading futures, in particular the E-mini S&P 500. So we discussed some of them already, but we'll go over them again. So you can trade almost any time you want to, right? Or whenever you have time to do it. Some people, some traders, they have a full-time job and they are not able to trade throughout the day like others can. So maybe they have to be at work by 9 a.m. and so they want to get up at, say, 7:30 or 6:30, whatever market time, and they want to trade futures for an hour or two before they have to go to work. Because your futures are always tradable. Well, if you were a trader like me, where your primary trading strategy is catalyst, well, maybe on certain mornings you may not have any catalyst to trade, right? We always see those mornings where there's just not much going on. Whereas with trading the S&P E-mini 500, there's always something going on. Maybe the setup that you're looking for may not happen, but it's typically tradable in some way every single day. So that's one benefit there. And also another benefit is it has high liquidity, right? So most of the time it's tradable. There's always, it's always liquid. We discussed already the times that it's not as liquid, or those oddball times, that traders are just, they just are not trading because, they can't spend 24/7, 7 days a week or 6 days a week trading. They would have no life. But definitely, the latter part of pre-market and absolutely the entire time throughout the regular normal trading hours, this is very liquid, very, very tradable. Very easy to get in and out of, in other words. So, and since futures are traded on the CME, which is the Chicago Mercantile Exchange, they have different rules. Okay, so there's no pattern day trade rule with futures. So if you have less than $25,000 in your account, therefore you would typically be under the PDT rule. Well, on futures, you're not. You can trade them as much as you want, as long as you have enough to cover whatever the margin requirement is for that particular future that you're trading, right? Another thing is there's no wash sale rule with futures. If you're not familiar with what a wash sale is, just Google it. It'll tell you what it is real quick. It's very important to pay attention to. But there is no wash sale rule on futures. So that is a definite benefit as well. And some people don't want to have to worry about looking at so many different companies. Like let's say you're a normal stock day trader, and you're having to keep up with all of these different companies, and you're having to keep up with maybe some of their fundamentals. You don't have to mess with any of that stuff when you're trading futures, right? You don't have to worry about, this particular stock that you got in last night, right before close, and you're holding it overnight. You don't have to worry about them doing an offering, the next day and the price dumping. You know when the next economic data is coming, or you might see a major change, or when some kind of something hits that it could be a major change for the futures. Then yes, you're careful there, but you don't have to worry about all the little things that you do with trading stocks basically. So that's another benefit that a lot of people like, right? So some of the drawbacks, I'll just give you a couple. There's not a ton, but I will give you a couple that I have found when I've traded it. I've never gotten a margin call on it, but I'm going to point that out as well. But trading the S&P E-mini 500, it can be very volatile, okay? And it can be tricky to trade. A lot of people, whenever economic data is coming out, there's a lot of traders that solely trade futures, that they won't even mess with it for that particular day when the data came out, because it's so volatile, right? Sometimes you'll see negative data come out and it'll tank really, really hard for the first few minutes, and then wow, it just bounces and goes right back up to that level. Well, nobody expected that, right? So a lot of times what they'll do, because it has such volatility right after those big economic data announcements, they'll wait until the following day when the dust has kind of settled, right? And then you kind of expect it to go in the direction that the economic data dictates that it should go, right? So that's one negative thing. It's volatile. It can also be tricky to trade. There's a lot of people out there that think trading the S&P E-mini 500 is a 50-50. It's like playing roulette. It's like pretty much a 50-50 shot. Well, I disagree with that. There are a lot of things that you can do to put the trade in your favor if you know what you're doing. If you don't know what you're doing, then yeah, it probably is about a 50-50. I don't know. Maybe it is. Maybe it's less. But there are a lot of things that you can do to put the trade in your favor, and that is our job as traders, to put as many things as we can in our favor so that we have an edge on that particular trade, right? So, and just like anything else, what we talked about before, there's a learning curve, right? So paper trade is your friend here. So, you would want to paper trade this until you feel confident before you throw any real money at it, right? And you want to maybe paper trade it in different hours, so whatever time that you would normally be able to trade it when you do start using real money, that's the time frame that you want to focus on when you paper trade it. Don't paper trade it at 2 a.m. When you have free time, let's say at 2 a.m., when otherwise, normally, you would be trading it at the bell, right? Make sure and paper trade it at the same time you would be trading it, so you get a good idea of, how it normally acts, right? Okay, so margin call. So you can get a margin call. I'll give you an example here. Let's say that you were trading the S&P E-mini here, and we saw just a moment ago that each contract is right around $15,800. So let's say that you had an account size of $17,000. So you have enough in your account to trade one contract, right? And so you take that trade, and then the trade starts to go against you. And for whatever reason, I don't know what that reason would be, but whatever reason, you decide to continue to hold it as it's going, down, 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 right? Well, once you get below that $15,800, you can get a margin call, right? So, and typically, you have to maintain, as long as you're still in the trade, you have to maintain that required margin amount, right? So your broker can issue a margin call, and you would typically have, 1 day, I think, the end of the next trading day or something like that, to be able to fund your account with additional cash, right? To bring your account back up. Or some brokers even may just close your trade for you, or they may close another trade, to get you back to where you need to be. So you just don't want to get in that situation. So just make sure that, just like with any other trade, that you are following your risk management plan. You're obeying your stop losses. That's another great thing about the S&P E-mini, because if you decide to, that, hey, I don't want to get up and trade pre-market at 5:30 in the morning or 6 o'clock in the morning, whatever time you normally get up, you say, hey, I'm going to sleep in until the bell, right? I'm going to sleep in until 9:30 and I'm just going to start, or till 9, let's say. So you can look at your charts on the E-mini, and you want to sleep in, then that's great, because now every time you take a trade, you can just do a bracket order so that your stop loss is already ready to go. Because let me tell you what can happen on the E-mini. Okay, this thing is so liquid that whenever you go, if your sell order or your buy order is not done pretty quickly, especially your sell order, because that's when you're looking to get out, you have to get in line. You'll see that during market hours, instead of 22, 38, 44, these numbers are going to be in the hundreds, right? You're going to see 200 or 300 here, 200 or 300 there. So, and keep in mind, it's first come, first serve on those levels, right? So if this stock is moving down and I didn't put a stop loss, I forgot to put my stop loss, let me come down here and put my stop loss here. Well, now keep in mind, you're in line at the back of the line from all of those other people looking to sell at that area. And that's what you want to be cautious of, because that's why it's always, always, always a very, very good idea. It's always a good idea to have a stop loss anyway, but it's especially a good idea with this particular future, because you're having to get behind so many other people looking to sell or buy, depending on which direction that you're going. So you always I always did a bracket order whenever I did, whenever I trade the S&P E-mini. I always did a bracket order, do a bracket order, so that you're already in there as quickly as possible. You get in line as fast as you can, basically. But that's another great thing about this, because it's primarily traded. Most people trade it during market hours, so you don't have to worry about a mental stop loss like we do in pre-market or after hours. You can actually put in an actual stop loss. But anyway, back to risk management, it's extremely important to respect and obey those stop losses. Don't hold and hope on this, because this thing can move really quickly in one direction or another, and you'll find that out by when you start watching it. So other times that you want to pay attention to are, like we talked about before, whenever this economic data is coming out. So if economic data is terrible, you can typically expect that futures are going to drop, right? We know pretty much already, just by, even if you don't have any experience with futures, we kind of know already by when they're dropping. We know that when the Fed comes out and they give us news that we don't want to hear, and inflation's going through the roof, and or interest rates are going to be raised, that anytime we have any of that bad news, you can watch futures will just dump. So those were some of my favorite times to trade them, and I typically would not do a quick trade on them during those times. I usually like to do a little longer hold on that, maybe a few hours, or if economic data came out, something nasty came out in the morning, or came out maybe yesterday from the Fed, and my expectation was for it to continue lower throughout the day, then I would hop in that trade, get a little bit of buffer room there, then put in my stop loss when I had that buffer room, or maybe adjust my stop loss once I had that buffer room, and then just basically put a trailing stop loss for however long you want to stay in the trade, right? Because that's when they're really going to pay off. Another way to do that is sometimes I would buy, let's say, 2 contracts, right? Well, what I would do is I would scalp one contract, let's say for 2 points, okay? So I'm looking to make 2 points on that one contract, and then that other contract, I would let it ride for a lotto play, or some people call it a runner, right? I call them lotto plays. So I would leave that second contract for a lotto play. So there would be a lot of times that I'd make, a couple $100 or whatever on my one contract, but then my second contract, I made $1,500 on it because I let it ride, right? So, and what I typically would do on those is, once I made my scalp, then I would put my second contract stop loss at my buy-in, right? So if it did come back to my buy-in, hey, big deal. I didn't lose anything other than my $7 broker fee on that particular contract. No big deal because I made money on my other contract, but I left myself an opportunity to have a lot more upside at that point with no downside, right? So that's something else that you can look at. And like I said, we're going to go over a lot more of those things in our next session. It's just if we went over that and what we went over today to give you guys just a kind of a brief overview of futures, our session would just be entirely too long. So I'm going to open it up for some questions now. That's all I have, and I'm going to stop the recording here.